economy, generally speaking, is fraught with downside risk. The global GDP growth is slowing down, and I think that we are teetering on the brink of a global recession. The US is cooling off. I think that by the first quarter, the whites of the eyes of the expansion are going to be shown. Canada north of the border is already heading into recession by most indicators, especially on the income side of the ledger. We have the UK is stagnant. Germany is heading into negative growth, and that's going to be the caboose for the entire European Union. And then we go to China, which is experiencing a debt deflation that perhaps isn't unlike what the US went through with its real estate morass back in 2006, 2007. So growth is slowing. I think it's going to tip into recession next year. Ironically, right after everybody and their mother has thrown in the recession call over the course of the past several months. Of course, if the recession hasn't come yet, then it's never going to come, right? It does remind me of 2007 when people were saying the exact same thing. So, that's my view. And as you said at the outset, I retain the constructive stance on the fixed income market, generally speaking, and very circumspect on what is still an overly inflated and highly concentrated U.S. stock market. Let's just go back to that period in 2008. The mantra of the day was global decoupling, and that the U.S. is going to slip into recession and everybody else is going to be just fine. Without understanding just how intertwined the global economy is. There were just lags that were separating what happened in the United States and then the spillover effect to the rest of the world. But China went through the ringer back then. It wasn't because of the US that the oil price went from almost $150 a barrel, in the summer of 2008. Within a year later, we're down to 30. That wasn't the US. That was China. China went into a downturn. That's what actually caused the meltdown in commodities. If you remember, beware of the mantras on Wall Street. Back then, it wasn't just global decoupling, but it was a China-led commodity supercycle. That went a long way, didn't it, in 2008 and 2009. This time around, it's actually a lot more synchronized. In China, the numbers there are abysmal on the economic side. Their economy, whether you look at consumer producer prices, corporate profits, they are contracting. And the United States has been living on the last vestige of the fiscal stimulus, especially the stimulus check, which were gargantuan and kept the expansion going through most of this year. That has basically run its course. But the major point is that most recessions are global. It's not usually just localized to one country. There's knock-on effects. And in this game of chess, there's different pieces that move at different times. But normally, you get a global recession, not just one country going into it. And this time around, as you said at the beginning, it wasn't just the Fed raising rates, but virtually every major central bank went into major overdrive when it came to raising interest rates dramatically and tightening liquidity. So right now, there's some countries that are entering into recession more quickly. I mentioned Germany having the influence on the rest of the continent. The UK is flat, they're going negative. Canada is already basically in recession. The Bank of Canada doesn't want to acknowledge it, and it's not ready to cut rates in advance of the Fed, although it probably should. And then in the first half of next year, we'll be seeing the signs that, well, what do you know? That even in America, the business cycle is not dead. I get the question all the time, are we going to have a soft landing? And it's a bit of a false narrative, and it's a false debate, because it's not whether or not we're going to have a soft landing. We always have a soft landing. The soft landing is the prelude to the recession. The soft landing is actually part of the business cycle. It's that bridge. It's that transition phase from the expansion to the economic contraction. 1979, soft landing. 1980, recession. 1989, soft landing. 1990, recession. 2000 is a soft landing year. 2001 a recession. 2007 is a soft landing year. Where's the recession? Where's the recession? Where's the recession? Yeah, wait till 2008. So all this soft landing is part of the business cycle. It's the transition phase. So that's what we've been in. So it's not about are we going to have a soft landing or not. We've been living in a soft landing. The question is, what comes next? And after a soft landing, you get the recession. The soft landing is just the appetizer. Now, there have only been 3 times in the context of a Fed tightening cycle where we avoided a hard landing recession, an NBER-defined recession. When were they? In the mid-1960s, in the mid-1980s, and the mid-1990s, when Alan Greenspan developed the moniker the Maestro. Now, those three cycles were special in the sense that the Fed stopped tightening once the yield curve flattened. They didn't continue to tighten into the inverted yield curve. This Fed, because it was shamed by the fact that it missed the inflation bulge, 1 month of 9% inflation, but they missed it, they kept on tightening through the inverted yield curve. And there are lags. So it's 100% true. Shame on all of us that were saying the recession was going to come this year. It didn't come this year. But, I'm under the same pressure, except more pressure from external individuals and, say, clients. I don't have Merrill Lynch management breathing down my neck as I did in 07. I was under tremendous pressure to take away my recession call in 07. Good thing I didn't, right? Because, as I said then and as I say now, the business cycle's not been repealed. And there is nothing more powerful than interest rates. Not fiscal policy, not trade policy, not the currency. Interest rates, as Albert Einstein famously said, are the eighth wonder of the world. And interest rates operate with a lag because the economy resets to interest rates with a lag. And sometimes other things get in the way. So in 2007, what got in the way? What caused the lags to be longer? That cycle was the last vestiges of the housing bubble and the ability of the household sector to continue into the final months of 2007 to continue to tap their home equity. Remember, the acronym back then was MEW, M-E-W, mortgage equity withdrawal and cash out refinancings. That Energizer bunny kept on going until it couldn't any longer. And then the interest rate effect, the lags kicked in. Look, here's what happened, okay? The historical record shows that when confronted with stimulus checks, the beloved American consumer historically would spend half and save half. That's why the Biden economics team went big. Go big or go home. They wanted $1 trillion of stimulus. So you had to go $2 trillion to get $1 trillion of economic impact. Who is to know that in today's narcissistic economy that we would have not MEW, but YOLO? You only live once. Anger spending, revenge spending, and I guess this is all the fallout from COVID, so that every last penny got spent. Where a lot of us went wrong was in the belief that half of the money was going to get spent and half the money was going to get saved. All of it got spent. So the savings rate today sits barely above 3%, whereas historically, before COVID, the normal savings rate was more like 7-8%. Historically, Americans, out of every after-tax dollar that they made, would take a dime and put it in the piggy bank. Today, it's 3 cents. So as the marginal household ran out of those excess savings, they were tapping their credit card debt at a double-digit rate over the past year. That process is ending because the delinquency rates going up have compelled the banks to tighten up the screws dramatically in terms of applications for new credit cards or applications for increased limits. That source of, quote, stimulus is over. But the San Francisco Fed, which I would say on the record is the Fed District Bank that actually publishes the best research, found that the last chapter of the excess savings story, which kept the Energizer bunny going this time around, ended in September, which of course had that exclamation mark of a 0.7% increase in retail sales. That's the rearview mirror. The one thing that we have to respect is Bob Farrell's rule number 1, which is about mean reversion. Now, levels don't mean revert, but ratios do. And the savings rate is a mean reverting statistic. And if a mean reverts to, say, 7-8% pre-COVID norm, how will that be accomplished? If it's accomplished through an income boom, well, that's a rather benevolent way to mean revert the savings rate. I think it's going to happen by households tightening their belts after their freewheeling spending ways of the past couple of years, which was always unsustainable. But the savings rate has hit rock bottom. And I know when I talk about a savings rate to non-economists, people they glaze over. But it is arguably the most important behavioral aggregate of the national accounts. And that is why the consumers hung in so well, why the economy is surprised in the face of rising interest rates this past year, why the recessionistas like myself were, I wouldn't say wrong, but just early. But because, who was predicting the savings rate would get this low? But that's exactly what happened. Going forward, the question is, how sustainable is that going to be? I think the banks are tightening up their credit scoring dramatically, and the labor market's cooling off. The unemployment rate is going up, and with a lag, that is going to cause wage growth to go down. And households are going to be compelled to bring their spending into better realignment with their income potential. And all that leads to a very significant cooling off in consumer spending, which is 70% of GDP. So I think that, the people that say, well, because and everybody threw in the towel on the recession, it's incredible. Just as he didn't know in 07, Adam, in 07, the only two economists left standing in the fall of 07, what the recession called, under tremendous pressure, internally and externally, were me and Dick Berner, who was chief economist at the time at Morgan Stanley. And everybody threw in the towel, just like they did this time around. Because of course, if the recession hadn't come, then it's not going to come. It's like me sitting here in Toronto saying to people, it didn't snow in December in Toronto, Canada, therefore winter's been called off. Okay? Just the lags have been longer this time for reasons that I stipulated, reasons that we can understand, but what's important is that they are reasons that don't have a longer fuse from here. So I think that by even this quarter, next quarter, the effects of the fiscal stimulus subside, but the rolling impact of the rising interest rate environment that we've been in, as the economy continues to reset to that environment, is going to have a big negative impact on GDP growth. And I don't think that's fully priced into any asset class right now.